But do you think sort of these, these cyclical type companies, consumer staples, not exactly sexy, that they could be the winners in 2022?
Today, we love cyclical stocks, value and cyclical stocks. So really, those likely to benefit from the reflation trade. Think about this recovery we're in right now. This recovery is so different than the last one. This one is more growth, more inflation. The last one was like a long, stretched out one. And we think valuations for cyclicals are very cheap. If you kind of pivot into which cyclicals do we like, we love energy, we love materials, we love industrials. Again, the reflation trade is still on despite the Fed. We'll talk about that later, hopefully. Also, you think about the three worst performing sectors in the S&P in the last 6 months are energy, materials, and industrials, despite the fact that earnings estimates for next year are really moving higher for all three sectors. And energy is one of our favorite sectors. I know some people say oil is going to hit $150 a barrel. We don't see that, but we do see a nice trend upward. Inventories are falling on rising demand, too little capital spending for oil and gas projects. And think about this, U.S. Oil production is about 2 million barrels less per day than it was pre-pandemic. Again, it's a good recipe to our 2022 theme. It's a good recipe for a good perspective in those cyclicals.
Well, and the CEOs we've talked about and heard about gotten smarter, returning cash to shareholders, not just getting dumb and putting more money into the ground. What about the Federal Reserve, though, Gene? I mean, they're up today. That's going to be the question. Do they crush the rally? Do they crush banks? Do they help banks?
Think about today. So today we are going to see the most hawkish dove plot pivot ever by the Fed. And, there's no surprise. Basically Powell came out a couple weeks ago and said, listen, we made a mistake about transitory. And also, if you look at our tool, we have a tool called the Phedometer that we produced a few months ago. We produced on an ongoing basis. This tool anticipates Fed policy shifts based on market conditions. And this tool, the Phedometer, is screaming, we need a more hawkish Fed. One example data point, the Fed funds rate is too low. You look at the spread between the Fed funds rate and CPI, this is at record wide. So what does that say for the Fed today? Three things. Number one, everyone expects it. We expect the Fed to double their taper. This puts an end to tapering around at the end of Q1 as opposed to Q2. Second of all, Fed raises inflation estimates. And the third of all, more dots suggest more likely of a rate hike in 2022. Think about the June dot plot. 7 Fed people said yes.
Yep.
Think about September dot plot 9. Today, we're going to see many more going to cross the dark side and say Fed rate hikes for next year. Again, the consensus is 2. Market is saying maybe 3. We are really saying 2. Inflation, yes, it's high right now. It should moderate to an extent. Year-over-year effects. Yep. But as you look at next year, the goods are going to slow down.